Okay, so this afternoon, one of the things that we're going to look at is the break-even analysis. Break-even analysis is one tool that is used in microeconomic analysis to attempt to find the level of sales that will result in a net income of zero, and that's accounting net income. Now, there are two things to consider when it comes to break-even. You can calculate the break-even in terms of units, and you can also calculate the break-even in terms of sales. Now, the formula for break-even in units is fixed costs over the price, unit price, minus variable costs. So that's unit price and unit variable cost. You'll remember that variable costs are those costs that are fixed at the unit level, but in the aggregate are variable. So if we have a scenario where we have fixed costs, and remember fixed costs can include such things as buildings, insurance, depreciation, and the like. Let's say we have fixed costs of $100,000. And we have sales, let's just work with a one product organization to keep this simple. We have sales, a sales price of $1 on a unit basis. That is, let's go with $2 for every item that you sell. You will be able to sell them at $2. And it costs you $1 to produce them from a variable cost perspective. Variable costs, if you recall, are things like raw materials and labor on an hourly basis. So plugging them into this formula, 100,000 divided by 2 minus 1, and we're basically just plugging into the formula, $100,000 fixed, $2 price, $1 variable cost. We get 100,000 units that we need to produce in order to break even. We can double check that by looking at sales and taking 2 times 100,000, or $200,000 in sales, and this is just a mini income statement, so sales, and our variable costs, because this cost is $1 for every unit sold, 1 times 100,000 is $100,000. We subtract this, we're left with 100,000 contribution margin. Then we subtract our fixed costs, net income of 0. This works from a unit perspective. What about sales? If we want to find the sales level, basically the same approach. Fixed costs over the contribution margin ratio. This is the ratio in our standard income statement. It is this percentage of sales. Here's an example. We have an organization. We're given information. The last quarter, we sold $400,000 worth of our single product. And it cost us $200,000 to produce those sales. Our contribution margin, that is the amount that contributes towards fixed costs, is $200,000. Using the same $100,000 from our prior example, our net income here is $100,000. But we want to know what level of sales do we need to achieve in order to break even, have a net income equal to 0. We can look at this percentage of sales as a total. So 200,000, I'm going to go over here, over total sales equals 0.5, or 50%. Our contribution margin ratio then is 50%. We can take, going back to our example here, $100,000 of fixed costs and divide by our contribution margin ratio. We need sales of $200,000 to break even. Let's go back and check, see if that turns out to be the case. We're going to leave our fixed costs in here at $100,000, sales of $200,000. Our contribution margin ratio is 50%, so that means this must be $100,000 because 50% of 200,000 was 100,000. That means that this necessarily has to be 50% as well. We subtract, we have a net income of 0. In sum, we looked at two approaches to finding the break-even point so an organization can plan effectively as to how much sales it needs to generate given its fixed costs, sales, and variable costs to break even. We had sales fixed over contribution margin ratio, which is your contribution margin divided by your sales. And over here on the unit perspective, it was the same fixed cost in the numerator divided by the unit costs of price minus variable costs.